So our topic for this session is your investments. So investment is an item of your financial asset together with your cash and cash equivalents, your loans and receivables, and the last item for your financial asset that we will discuss is your investments. So before we go further and look into the different types of investments, we go back to the definition of a financial instrument. So what is a financial instrument? A financial instrument gives rise to a financial asset of one entity and a financial liability or equity instrument of another entity. Okay? So a financial instrument gives rise to a financial asset of one entity and a financial liability or an equity instrument of another entity. Okay, so you already know that cash, loans, and receivables and investments are all financial assets. But this cash and cash equivalent and loans and receivables are purely financial asset, and the counterpart is a financial liability. However, an investment is a type of a financial asset that has the counterpart of either a financial liability or an equity instrument. Okay, so if you have a financial asset such as an investment, we said that your counterpart can either be a financial liability or an equity instrument. So, what is that counterpart? So, the financial liability counterpart of another entity is the bonds payable. So, normally, the another entity will issue a bonds payable or a bond indenture, and you will invest on those bonds. Before, we call it investment in bonds, but now we call it investment in debt securities. So, the financial asset here is the investment in debt security for one entity, and the financial liability on another entity is known as your bonds payable or your bonds. Next, the equity instrument of another entity is either a common stock or a preferred stock. So, common stock or a preferred stock. But the financial asset of one entity here is the investment in equity securities. Okay? Investment in equity securities. So, again, the financial asset here in our financial instrument can either be investment in debt securities and investment in equity securities. The counterpart of your investment in debt securities is the financial liability, which is known as your bonds payable or your bonds. And then you have your investment in equity securities. That is your equity instrument in the form of a common stock or a preferred stock. In the form of a common stock or a preferred stock. Now, this investment in debt and investment in equity securities gives rise for our classification of investments. So to classify your investments, we classify it according to the nature of the financial asset. So first, we have your investment in debt securities. And then we have your investment in equity securities. Okay. So when can we classify it? With as an investment in debt securities or as an investment in equity securities. We can classify it as an investment in debt securities if you invested in a bond or in a debt investment. So any investment in debt in the form of bonds, that is investment in debt security. So if that is an investment in equity security, that is an investment which give you ownership shares over one entity. So that ownership shares can either be a common stock or a preferred stock. So you have ownership interest or ownership shares in one entity, common stock or preferred stock. So to classify your investments here as a financial instrument, it can either be investment in debt security, investment in equity security. Another, to classify your investments according to its measurement, we have your fair value. According to measurement, we have your fair value and your amortized cost. So If we classify our investment as a fair value, we measure our investment at fair value. While at amortized cost, we initially measure it at the purchase price plus your transaction cost and subsequently measure it at amortized cost. A quick throwback on your amortized cost. How do we amortize again? We have your interest income less interest received less principal repayment. We have your amortization. And we've learned this one in notes and in loans receivable. Okay, so to classify your investment according to its measurement, we can classify it as an investment at fair value or an investment at amortized cost. If that is an investment at fair value, you initially and subsequently measure it at fair value. And then if that is an investment at amortized cost, you initially measure it at purchase price plus transaction cost and subsequently measure it at your amortized cost. And how does your amortized cost works again? We have your interest income, less interest received, less principal repayment, that is an amortization. Why is this important? To know whether it is a positive amortization or a negative amortization. Because if that is a positive amortization, we need to add it on the value of our investment. But if that is a negative amortization, then we need to deduct that on the amount of our investment. Okay? Now, going further, we can also combine these classifications according to its nature and its measurement. Therefore, we can say that a debt security or investment in debt can either be at fair value or amortized cost. And then we have your investment in equity securities that can only be at fair value. Sir, question. Why is amortized cost not part of your investment in equity securities? Because guys, amortized cost pertains to the contractual cash flow collections, particularly on the collection of your interest and the collection of your principal. Kaya nga, meron tayo dito, less interest received, less principal repayment. So those are the contractual cash flows that we collect, interest and principal. And by that, you can amortize it over the life of the investment or the bond. So what we do here is the carrying amount versus the face amount, and whatever is the difference will be amortized over the life of that particular investment. That's for amortized cost. And take note, one thing that we need to amortize is the contractual cash flow collection of interest and principal. Now, in your equity securities does not bear maturity date nor a maturity value. It does not bear any maturity date nor maturity value. Therefore, we do not expect the contractual cash flow collection of interest plus principal here. We do not expect the collection of interest plus principal here. The main problem in your investment in equity securities is that whatever is the amount of your equity security, you cannot get it at par value. You cannot get it at par value or at the face. You cannot get it at par value or at the face because the value will always fluctuate. Kasi nga, wala siyang maturity value. Wala siyang maturity date. Hence, we cannot apply the amortization of any interest and principal because of those items. In the exemption of irredeemable preference share. You already know this one. Irredeemable preference share is not an equity security, right? Although it is a preference share, kasi nga equity yan, pero it is not an equity security. Why? Because it has the characteristics of a debt security. It bears maturity date, it bears maturity value. Remember, in our cash and cash equivalent, we have already said that irredeemable preference share is an exemption to your equity investments or equity securities because it has a maturity date and it has a maturity value. Therefore, it is not an equity security, but more of a debt security because of its characteristics. Okay? So investment in equity securities can either be measured, investment in debt securities can either be measured at fair value and amortized cost, while your investment in equity securities can only be measured at fair value. The reason is because you don't have any contractual cash flow characteristics or collection in your equity securities, which now needs to be amortized, unlike in your investment in debt. Okay? So here is our class. These are our classifications. First, we classified it according to the nature of the investment based on the definition of a financial instrument. We have your equity investment in debt securities and investment in equity securities. And then we also classify it accordance to your measurement. We have your fair value. It is initially and subsequently measured at fair value. And then for amortized cost, initially measured at purchase price plus transaction cost, and subsequently measured at amortized cost. Okay, so we go now to your recognition and measurement of investments. So this is how we normally discuss all of our topics. We go first with how do we recognize it, how do we measure it, how do we present it, and then we end our topic after our presentation. Okay, so normally we do that. So let's start now and dwell with investments per se. So we start with recognition. When do we recognize your investment in equity or debt securities? Remember, financial instrument gives rise to a financial asset and a financial liability or equity instrument of another entity. So here we have two parties, a party with a financial asset and a party with a financial liability or equity instrument. A party with a financial asset and a party with a financial liability or equity instrument. So how do we recognize then an investment? You recognize an investment if you are a party to the financial instrument. Party to the financial instrument. So once you are a party to the financial instrument, particularly you have a financial asset, then you can recognize either investment in equity or investment in debt. Next, we go with your measurement. We go with your measurement. So in measurement, we need to discuss the three classifications of your measurement, or actually it's just two, but then normally books tell it is a three-type measurement. So what are those measurement again? So we classified already an investment according to measurement. What are those two? We have your fair value and your amortized cost. But further, they say that fair value can be classified as fair value through profit or loss and fair value through other comprehensive income. So it can either be fair value through profit or loss or a fair value through other comprehensive income. Kaya, naging tatlo. But actually, it's only fair value or amortized cost. And fair value can be classified further as FVTPL or FVTOCI. Ganun siya. Okay? So, your measurement can either be an investment at fair value through profit or loss, or investment at fair value through uh, other comprehensive income, and or an investment at amortized cost. Okay, so before we go further on the differences of these three items, we need to discuss first on how do we classify an investment as such, either FVTPL, FVTOCI, or amortized cost. So first, how to classify. So how do we classify your FVTPL, FVTOCI, and amortized cost? So this standard, particularly PFRS 9, provides for two tests for classification. First, we have your business model test, and then we have your contractual cash flow test. Okay, so we start first with your business model test. So under your business model test, we determine the business model or the ordinary course of the business in holding the investment. So this is an overall test as to your investment. So when we say overall test, whatever are your investments purchased, you should measure it based on your business model. So whatever is the ordinary course, overall ordinary course of the entity as to the holding of investment, we apply it to all your investments. How about a contractual cash flow test? Because normally we don't have a business model. We don't have a particular company which really uh, purely business model siya. So, hindi lahat ng kumpanya business model. Naintindihan yon? Bakit? Kasi only those who really holds investments for trading, such as your different intermediaries as to your investments, they can be classified based on business model. But If you don't have an ordinary course of holding your investments, then you go with your contractual cash flow test. So what is your contractual cash flow test? So we base your contractual cash flows of your investments. So each investment, we look as to our contractual cash flows, whether we have a contractual cash flow characteristics, and we look on those contractual cash flow and we apply it item by item. So let's say contractual cash flow niya is to collect and then we sell it. So how do we apply it? Ganon. Next, purely contractual cash flow done. So ano yung apply natin? So ganun yung ginagawa natin. So if we don't have a business model, then we look into our contractual cash flow. And under contractual cash flow, we test it item by item. Unlike your business model test, wherein we test it for your overall. Meaning whatever is a business model of holding that investments, all other investments should be measured using that business model. While your contractual cash flow, item by item. So how do we classify them? Under FVTPL, normally we classify it based on your business model. And then our business model here is for trading. If we are actively trading our investment, therefore, meaning your business model is to trade investments. So what do we mean by actively trading investment? You keep on buying and selling investments. You keep on buying and selling investments. That is your business model of trading. And then at some point, you can also classify it as a VTPL if ever you designate it. So what do we mean by designation? So meaning you don't have a business model. You don't have a business model. And you don't know the contractual cash flow of that particular investment. Then you can designate it at FVTPL. Okay? You can designate it at FVTPL. Next, FVTOCI or fair value through other comprehensive income. How do we classify it? We classify it based on your contractual cash flows. So collection of contractual cash flows plus it is held for sale. Plus it is held for sale. So what is the difference of these two items, FVTPL and FVTOCI? We said a while back in your FVTPL, that is for trading, meaning we buy and we sell investment. While in your FVTOCI, it is held for sale. What's the difference? If that is for trading, you buy, you sell, you buy, you sell. In your FVTOCI, you buy, you hold because you need to collect, and then if ever it is available for sale. Meaning, hindi ka actively na pagka binibili mo siya, ibebenta mo agad. You still need to collect contractual cash flows before you sell it. It's only available for sale. It is not actively for sale. Unlike for trading, it is actively for sale because you keep on selling it. While in FVTOCI, it is only available for sale or held for sale. But you still collect for contractual cash flows. Fair value through other comprehensive income. Next, amortized cost. Amortized cost. When do we apply your amortized cost? We apply your amortized cost if purely for collection of contractual cash flows. If purely for collection of contractual cash flows. Okay? Purely for collection of contractual cash flows. Now, so since we already know how to classify your investments, whether FVTPL, FVTOCI, or amortized costs, based on the two tests, business model and contractual cash flow test, I think we further discuss now investment in debt securities. So we start first with investment in debt securities, and we look as to the differences of the three measurement, FVTPL, FVTOCI, and amortized costs as we go through. So our first topic then for investment is investment in debt securities. Okay? So we go now and look as to the differences of the three measurement criteria for investment in debts. Okay. So first, as to your initial measurement. So what is the differences or what are the differences of your initial measurement as to your debt securities for FVTPL, FVTOCI, and amortized costs? So under this standard, it provides that you measure your investments or your financial asset at fair value plus transaction costs, except for assets classified at FVTPL, it should be measured at fair value. So what does that mean? It means that FVTPL will only be initially measured at fair value, while FVTOCI and amortized costs is measured at fair value plus transaction cost. Okay? So initial measurement, if that is FVTPL, we measure it at fair value. FVTOCI, fair value plus transaction cost. Amortized cost, fair value plus transaction cost. So notice, FVTOCI and amortized cost is the same, unlike your FVTPL, as to your initial measurement. Sir, what is the fair value in the problem? The fair value is the purchase price. And the fair value is the purchase price. Later, we will discuss what is that purchase price. So initial measurement, fair value plus transaction cost. Now, since we already know our initial measurement, we dwell with the treatment of transaction cost. Treatment of transaction cost. So what is the treatment of transaction cost in your fair value at fair value through profit or loss? So under your fair value through profit or loss, how do we treat your transaction cost? We treat your transaction cost as an expense. So it is expense, meaning it is not part of the cost of the investment. So not part of the cost of the investment. While in your FVTOCI, what is the treatment of your transaction cost? It is capitalized. It is part of the cost of the investment. How about in amortized cost? It is also capitalized, meaning it is included as part of the cost of the investment. So as you can see in the initial measurement, a VTPL fair value only. So transaction cost is ignored. While FVTOCI and amortized cost, we have here fair value plus transaction cost. So transaction cost is added to the fair value, meaning the transaction cost is capitalized or part of the cost of the investment. Okay? Treatment of transaction cost. Next, subsequent measurement. How do we subsequently measure your investment under FVTPL, FVTOCI, and amortized cost? So under FVTPL and FVTOCI, it is measured at fair value. So what is that fair value? That is the fair value at the end of reporting period. At the end of reporting period. So whatever is the fair value, let's say that is calendar year. So December 31 fair value or January 1, whatever is the fair value, that is the amount of our subsequent measurement. How about your amortized cost? How do we subsequently measure it? Remember, we subsequently measure it at amortized cost. So as early in our introduction, we already said we can classify investment according to measurement. If that is fair value, initially measured at fair value, subsequently fair value. While your amortized cost, it is initially measured at purchase price, subsequently at amortized cost. So here, subsequent measurement, fair value for FVTPL and FVTOCI respectively, and for amortized cost. So ano naman ang pareho ngayon dito? Ang pareho ay ang fair value through profit or loss and fair value through other comprehensive income. So since it is subsequently measured at fair value, therefore, we look as the changes in fair value. Changes in fair value. So how do we treat the changes in fair value in your FVTPL? The change in fair value is presented in profit or loss. It's presented in profit or loss. So how do we compute for your change in fair value? So to compute for the change in fair value, it is equal to your beginning carrying amount versus the fair value end. So we get the fair value end. We compare to your beginning carrying amount. So we just compare and get the difference that is presented at profit or loss. So this can either be a gain or a loss. Gain or a loss. So, sir, how can we say it is a gain if the fair value is greater than your carrying amount? That is a gain. If the fair value is lesser than the carrying amount, that is a loss. Next, how about in your FVT OCI? How do we treat the change in fair value? The change in fair value is presented as an item of other comprehensive income. It's presented as an item of other comprehensive income. So it's presented at OCI. Okay? So you already know the items of OCI, right? We only have how many items? 5 items, right? 5 items as item of OCI. So One item is the changes in fair value of investments measured at fair value through other comprehensive income. The item is presented in OCI, and OCI is an item of equity, di ba? OCI is an item of equity. So in case, guys, you are asked, what is the gain or loss presented in equity? That is the OCI. That is the OCI. So how do we compute for your gain or loss here? So we have your fair value end less your beginning, no, not your beginning, less your adjusted carrying amount. So what is this adjusted carrying amount? That is equal to your beginning carrying amount plus or minus your amortization. So remember how to compute your amortization again? Interest income less interest received less principal repayment. That is the amount of your amortization. You add or deduct it. Either it is a positive amortization if you add, you deduct if that is a negative amortization. Okay? And then you compute for the gain or loss, which is now presented in your OCI. Gain or loss presented in your OCI. Next, amortized cost. How do we treat your changes in fair value? The change in your fair value in amortized cost is ignored. Change in fair value in amortized cost is ignored. Why? Because again, we subsequently measure it out at amortized cost, not at fair value. So it is ignored, guys. Okay, next. Sir, how about the change in fair value? Sabi kasi natin ignored. Will we not consider it in the impairment? Will we not consider it in the impairment? Diba? Kasi nga, change in fair value. No, it's still ignored. Change in fair value means the increase or decrease as to the value of the investment. So these are increase or decrease in the value of the investment, particularly on the market value. And remember, how do we impair again using amortized cost? We impair by getting the carrying amount versus the present value of future cash flows. Remember this? Carrying amount versus present value of future cash flows. This normally is the recoverable amount, the present value of future cash flows. Therefore, what is important as to the investment is not the fair value under amortized cost, not the fair value, but the future cash flows. So totally ignored ang change in fair value. The fair value is not even needed in computation of impairment. Because again, how do we compute for impairment? Present value of future cash flows. Therefore, we ignore it, both as the subsequent measurement and both as to your impairment. So we go now to your impairment. So as to impairment, do we impair fair value through profit or loss? It is not impaired. Not impaired. Sir, why is a VTPL not impaired? It is not impaired because you already measure it at fair value. So precisely, it is already at its current value. So any impairment, gain or loss, is presented now as a profit or loss gain. Diba? So the changes in fair value is already presented. Hence, it is not impaired. Not impaired. Why? Because it is already measured at fair value. Now, in your FVT OCI, will we impair it or not? Sir, it is already measured at fair value. We should not impair it. No, mali kayo doon. Remember, in your OCI, we have here a collection of contractual cash flows. Remember, plus held for sale. Kaya lang naman siya na-measure at fair value because of this held for sale. So we still have a collection of contractual cash flows. So our problem here is the impairment of the collection. That's why we can impair. We can impair. So this can be impaired. FVT OCI can be impaired. On what reason? So although it is measured at fair value, it is impaired due to the collection of contractual cash flows. How do we compare again? And compute for your impairment, that is your carrying amount versus your present value of future cash flows. So that is the amount of your impairment. Next, how about your impairment as amortized cost? Can we impair? Of course, we can impair. How do we impair? Nasabi naman na natin yan kanina. Carrying amount versus present value of future cash flows. That is as to impairment. As to impairment. Last difference, as to interest income. So how do we compute for your interest income? Your interest income based on your FVTPL is equal to your nominal rate or your stated rate multiplied by the face amount. nominal rate or stated rate multiplied by the face amount. How about your interest income as your FVTOCI and amortized cost? So as to FVTOCI, how do we compute it? It is equal to your carrying amount per your amortization. So this is the amortized amount, carrying amount, multiplied by your effective interest rate or your market rate or your yield rate. So alam naman na natin to, di ba? Kung paano mag-compute using your amortization table, the carrying amount multiplied by your effective interest rate. How about your amortized cost? How do we compute the same carrying amount based on your amortization multiplied by your effective interest rate? So anong pareho dito sa interest income? Ito. Impairment, anong pareho? Ito. Change in fair value, anong pareho? Wala. Walang magkakapareho sa change in fair value kasi iba-iba sila ng treatment, di ba? Profit or loss, pag na get the difference agad on your OCI, you just need to adjust first the carrying amount, and then in your amortized cost, it is ignored. Okay, so these are the differences of your investment in debt securities. So initial measurement, treatment of transaction costs, subsequent measurement, change in fair value, the impairment, and to your interest income. Okay? For this session, our topic is your investment in equity securities under PFRS 9. So just a quick recap, under PFRS 9, we classify your investments as either fair value or amortized cost. Under fair value, we have FVTPL and FVTOCI. So we have your debt and we have your equity. Debt and your equity. So for debt, VTPL, FVTOCI, and amortized cost applies. While for equity, VTPL and FVTOCI only applies. So why again? That your equity cannot be measured under amortized cost. It cannot be measured under amortized cost because equity does not have any contractual cash flow characteristics as to the collection of principal and interest, which is necessary to amortize a particular amount. Therefore, equity does not have amortized cost category. Therefore, in this particular session, we will focus ourselves into the measurement of your equity under FVTPL and FVTOCI. So let's look again as to the differences of FVTPL and FVTOCI. So when do we classify again an item as FVTPL and FVTOCI? We classify an item as FVTPL based on the business model, if ever it is for trading. FVTOCI, if ever it is for sale, or it can also be designated. It can also be designated. Take note, you can designate it, guys, whether it is FVTPL or FVTOCI. You can designate it whether it is FVTPL or FVTOCI. So you can also designate here. You can also designate in your FVTOCI. Most importantly, this is applicable for equity securities because your equity securities are normally FVTPL. So you probably would only place it in your FVTOCI if ever you can designate it. Sir, why is your collection not included in your FVTOCI? Because in our debt investment before, we said to classify it as FVTOCI, we are to collect the contractual cash flows plus it is held for sale. But why now your FVTOCI is purely for sale? Because guys, we do not collect any contractual cash flows here. Unlike in your debt, there is a contractual cash flow characteristic, particularly the collection of your principal and interest. In your FVTOCI, we do not collect. We do not collect. Therefore, there's no collection criteria here as to the classification. Next, as to your recognition. When do we recognize again FVTPL and FVTOCI investments? Once you are a party to the instrument. Another difference, as your initial measurement, FVTPL, how do we measure it? Fair value only. FVTOCI, how do we measure it? Fair value plus transaction costs. Now, as to the changes in your fair value. In your changes in fair value, FVTPL, where do we place it? Profit or loss. FVTOCI, we place it in your other comprehensive income. Now, your subsequent measurement, both are subsequently measured at fair value. How about the treatment of transaction costs? Under FVTPL, what is the treatment of your transaction costs? It is expense. FVTOCI, it is capitalize. Okay. Impairment. Dito naman tayo sa impairment. So guys, if we look at it, the only main difference that we can see now is your FVTOCI and this one, impairment. So all those items that we learned under your debt investments are almost the same with your equity investments, except for these two items, for your TOCI and your impairment. Under FVTPL, do we impair? The answer is no, because it is already at fair value. Under your FVTOCI, equity security, do we impair? The answer is no, because this is already at fair value. Sir, question. Before FVTOCI debt, remember this one, FVTOCI debt can be impaired. Can be impaired. Okay, it can be impaired. But now, FVTOCI equity cannot be impaired. Bakit kaya? Pansinin nyo. Doon sa classification natin, una pa lang sinabi ko, there's no collection. Hence, you cannot now impair the collection. Kasi nung una, sa debt natin, nag-i-impair tayo kasi may collection of contractual cash flows. Baka magbago yung collection natin. Dito, hindi na tayo mag-impair kasi nga, wala nang collection, wala ka nang i-impair. At saka, naka-measure na siya at fair value. So, sabi ko nga kanina, the differences of your equity and your debt lies purely on your FVTOCI. Here, as to the classification and as to your impairment, take note of this. Classification, because you can designate it now, because normally it is under FVTPL, but you can designate it in your OCI. Now, as to impairment, we cannot impair it. Why can we not impair it? We cannot impair it because there's no collection of contractual cash flows. Okay? We only impair if there is a collection of contractual cash flows. That's why nga, dun sa debt ninyo, we have FVTPL, FVTOCI, and amortized cost. Both FVTOCI and amortized cost may collection characteristics yan. Kaya yung dalawa, ang ginagawa natin is we impair them. We impair them. Here, we only have your FVTOCI, but no collection. Therefore, you do not need to impair it. You do not need to impair it. Okay? So, ito yung difference nila ng FVTPL and FVTOCI. That's why I want to emphasize PFRS 9 not based on the classifications. Kasi pag inuna natin yung classifications at hindi natin hinati yung debt securities at equity securities under FVTPL, malilito na kayo. Tandaan to FVTOCI equity securities are not impaired, but FVTOCI debt securities are impaired because of the collection item under your FVTOCI debt. Okay? So I hope we are clear. Sir, how about interest income? Do we record interest income now? No, because this is not debt. What we record here is your dividend income, but that will be a separate topic which will be discussed in your subsequent items on your equity securities.